QYLD and GPIQ are both covered call ETFs on the NASDAQ 100. In January 2024, QYLD was paying 12.5%. GPIQ was paying 10.9%. So I put $500,000 into each one on the same day and spent every distribution the same way that someone living on this money actually would. GPIQ's first monthly paycheck was about $4,500, while QYLD's was about $5,100. However, 2.5 years later, GPIQ is paying about $6,000 a month, while QYLD is paying about $5,400 a month. The fund that started $674 a month behind is now $632 a month ahead. How is the fund with the lower yield already producing more monthly income than the higher yield fund, just 2.5 years into retirement? As you'll find out, the starting yield on a covered call ETF tells you almost nothing about the paycheck you'll actually be living on years from now. Before we run that test, there's a problem with it. GPIQ launched in October 2023. So 2.5 years is the entire history of the fund. That is not enough to prove anything by itself. QYLD, however, is a different story. It launched in December 2013, which means that there are 12.5 years of data sitting there on what this kind of fund actually does to a retirement account over time. So that's where we start. What QYLD has done since inception tells you whether what happened in the last 2.5 years is a pattern or an accident. Then we put the two of them side by side. One note on the numbers though. Everything in this video runs through mid-July 2026 using closing prices and every distribution declared through that date. December 2013, QYLD opens at $25.04 a share. $500,000 buys you 19,968 shares and you hold every one of them. You never sell a share, you never add a dollar, you just collect the checks. Here's what that share price does over the next 12.5 years. Today, it's $18.25. Every share you own is worth $6.79 less than the day you bought it, and that $500,000 is now worth about $364,000, down roughly 27%. Now look at when that happened. Not through a lost decade, not through a crash and a long grind back. That decline runs straight through one of the strongest bull markets in American history. The NASDAQ 100 spent those 12.5 years climbing, and the fund that owns those exact companies gave up a quarter of its share price. Now look at the paycheck. In 2014, that $500,000 account produced an average monthly distribution of about $4,300. That number was never perfectly steady. When volatility rose, option premiums increased and the checks generally got larger. During quieter markets, they tended to shrink, but across the year, the average came out to roughly $4,300 a month. Fast forward 12 years. In 2026, the exact same shares are producing an average of only about $3,560 a month. Nobody sold any shares and no money was withdrawn from the principal, yet the monthly paycheck is down roughly $750, while the account behind that paycheck has fallen from $500,000 to about $364,000. So after 12 years, the investor is living on a smaller monthly income backed by substantially less principal. And that is only the dollar amount on the check. Inflation over those same 12 years ran about 36%. So that original $4,300 monthly check, to maintain the same buying power it had in 2014, it would need to be paying roughly $5,900 a month today. Instead, it is paying only $3,560. After adjusting for inflation, that $3,560 check is equivalent to receiving roughly $2,590 a month in 2014. So even though the investor still owns the exact same number of shares, the income those shares produce has lost about 40% of its purchasing power. And the damage is not limited to the paycheck. The original $500,000 account has fallen to about $364,000. After adjusting that remaining balance for inflation, its purchasing power is equivalent to only about $268,000 in 2014 dollars. So the investor did not just lose $136,000 in principal. What remains is also worth substantially less than it was when the investment began. So why does that happen? QYLD sells call options on the NASDAQ 100 at the money across essentially the entire portfolio. It collects the option premium and distributes that income to shareholders. At the money means the option strike is set very close to where the NASDAQ 100 is trading at the time. So once the index climbs above that strike price, QYLD no longer participates in most of that additional gain. The fund keeps the premium collected, but the buyer of the option gets the upside of the strike. That trade works well for producing income today. The problem is what it does to the value of the fund over time. When the NASDAQ moves sharply higher, QYLD does not fully come along for the ride. It collects the premium, pays out the income, and gives up much of the growth that could have increased its net asset value. And that matters because the distribution is ultimately being generated from the value of the assets underneath it. If that asset base does not grow, there is no larger base supporting a larger future check. Now, to be fair, QYLD is not broken. It is doing exactly what it was designed to do. It is trading away much of tomorrow's upside to produce much more income today. And that raises the question this entire video is built around. What would another fund have to do differently? It would have to leave some of the upside alone, right? Goldman's GPIQ holds a portfolio built around many of the same NASDAQ 100 companies. The difference is how much of that portfolio it writes calls against. Instead of covering essentially the entire portfolio, Goldman can cover anywhere from 25% to 75%, adjusting that number based on market conditions. In June, the average coverage was 32%. That means roughly 1/3 of the portfolio was capped by call options, while the other 2/3 remained open to participate in the market's upside. The result is a smaller paycheck up front because GPIQ is collecting option premium on less of the portfolio, but that is the trade. QYLD sells more upside to generate more income today. GPIQ collects less income today so that more of the portfolio has room to grow. GPIQ launched in October 2023, so its record is still very short. It has not been through a full bear market or a prolonged recovery, but it has experienced the 2025 sell-off and the correction earlier this year. That gives us two real stress tests and an early look at how the strategy behaves when the market falls and then begins to recover. So now that we understand the differences in how each ETF produces their income, here's the test. January 2nd, 2024, you put $500,000 into each fund on the same day. At $17.23 a share, QYLD buys you roughly 29,000 shares. At $43.24 a share, GPIQ buys you roughly 11,500 shares. Then the first checks arrive. QYLD pays about $5,200 that month. GPIQ pays about $4,500. So right out of the gate, QYLD is producing roughly $700 more per month. QYLD is yielding right around 12% and GPIQ is paying a little under 11%. If you were choosing between them that day based on the income they produced, QYLD looked like the better choice. It started with a bigger paycheck and the yield clearly supported it. Now, let's see whether that advantage lasted. 13 months into the test, QYLD is still winning. Where it matters most is someone spending the income. The account is now worth $536,000 and the monthly check has climbed to just under $5,500. That is the largest distribution QYLD pays during this entire test. GPIQ's account has grown even more. It is now worth about $575,000, but its monthly check is still only about $49.60. So the Goldman investor has nearly $40,000 more principal, but the QYLD investor is still receiving roughly $500 more each month. If your priority that morning is the amount of cash arriving in your account, QYLD is still ahead. The account value says GPIQ is building something underneath the paycheck, but 13 months in, that growth has not yet translated into more income. Then we move on to April 2025 when the market broke. From the February high to the April bottom, both funds fell by roughly 21% to 22%, and both monthly checks also fell. QYLD's distribution dropped to about $4,650. GPIQ's fell to roughly $4,450. But now look at the account values at the bottom. QYLD is worth about $473,000. GPIQ is still worth about $518,000. So even after both funds took almost the exact same hit, the Goldman investor is still sitting on about $45,000 more principal. That gap was built before the sell-off ever started. GPIQ had captured more of the NASDAQ's rise on the way up, so when both funds fell, it entered the decline from a much stronger position. July 2025 is where the income comparison finally turns. For the first time, GPIQ's monthly check passes QYLD's, and once it moves ahead, it never gives the lead back. By August, GPIQ was already paying more than it did before the sell-off began. On the income side, it fully recovers in about 4 months. QYLD does not. 18 months later, its monthly check still has not returned to the high it reached in January 2025. Then we move on to March 2026 and we get a second test. QYLD fell about 7%. GPIQ fell about 11%. At the bottom, the QYLD account was worth roughly $498,000 and producing a monthly check of about $5,000. GPIQ was still worth about $572,000 and paying roughly $5,240 a month. So by this point, the entire comparison had flipped. QYLD no longer had the larger account and it no longer had the larger paycheck. The income advantage that started in QYLD's favor was now running the other way, backed by roughly $74,000 more principal. Now look at where the two accounts stand today. The QYLD investment is worth about $530,000 and producing a monthly check of roughly $5,370. The GPIQ investment is worth about $664,000 and paying about $6,000 a month. So the Goldman investor now has approximately $134,000 more principal and is receiving about $600 a month more in additional income. And the difference shows up at the share level too. Over the 2.5-year test, QYLD's monthly distribution per share increased by only about 3%. GPIQ's increased by roughly 33%. Goldman started the test paying about $700 less per month. Today, it is paying about $630 more. The fund that began with a smaller check now has both the larger account and the larger income stream. But there is one number that argues in QYLD's favor. Add up every dollar of income paid during the entire test. QYLD distributed about $166,000. GPIQ distributed about $155,000. So after 2.5 years, QYLD put roughly $11,000 more cash into the investor's hands. That income advantage was real, but at the end of the test, the QYLD investor was also left with about $134,000 less principal. Now look at what happened to the yields through all of this. QYLD remained the higher yielding fund the entire time, generally running between about 12 to 12.5%. GPIQ remained the lower yielding fund, generally running between 10 and 11%. Goldman did not out-yield QYLD in a single month of this test, and it never needed to. The yield did not have to become larger for the check to become larger. Yield is only a percentage. The dollar amount you receive depends on the value that percentage is being applied to. GPIQ's account grew from $500,000 to about $664,000. The QYLD account grew to about $530,000. Once the difference between these two asset bases becomes large enough, GPIQ's lower percentage began producing the larger check. So the investor comparing 12% against 11% in January 2024 was completely right about which fund had the higher yield. They were just wrong about which fund would eventually be writing the bigger paycheck. Now, to be fair, 2.5 years, 2 sell-offs, and neither one was a real bear market. GPIQ had never seen a 2008 or a 2022, and this window was a strong stretch for the NASDAQ, which in this environment where a partially covered fund does best by design. Run the same test through a flat, choppy market and full coverage collects more premium than Goldman does. That is a real argument, and it is the strongest one against everything I just showed you. So here's what the data supports. On QYLD, we have 12 years and a mechanism. The payout is a slice of net asset value, and riding at the money against the whole portfolio sells off the growth that would raise that value. The check has no engine for growth, and across 12 years, it hasn't grown. On GPIQ, we have 2.5 years and a mechanism pointing the other way. Leave part of the portfolio uncapped, the asset value can grow, and a bigger base writes bigger premiums. One of those is proven, the other one is early. They are two different systems, and you can see what each one was built to do. So to wrap all of this up, every one of these funds leads with a distribution rate, and on the page they all look the same. 12%, 10.9%, even 11.5%. What that number can't tell you is what the fund had to sell to produce it. That's what decides whether the NAV grows or bleeds, and the NAV is what your paycheck is a percentage of. So the question was never which one pays you more this month. Everybody walks into retirement with a different idea of what it's supposed to look like. Some people get there undercapitalized and need every dollar this money can produce right now. Some people get there in good shape and want it to keep growing for another 20 years. Most people fall somewhere between those two extremes. But wherever you fall, the decision runs to the same question. How much future growth is the fund giving up to produce the income it is paying you today? Which one of these would you actually put money into, QYLD or GPIQ? Drop it in the comments and tell me why. And if there's another covered call ETF or just a normal ETF you want to see tested on this channel, let me know. If this changed how you look at a distribution rate, hit the like button. It helps this reach other people while trying to figure out the same question. If you want more rules-based investing, real data with no hype, hit subscribe. Stay disciplined, stay patient, and I'll see you on the next flight.